Hi, welcome to iEducator. This is Teacher Jeff. I'm an educator and an engineer by profession. And today we will discuss Chapter 4. And Chapter 4 is all about transaction analysis and journal entry preparation. Now, there are six key areas that I'm going to be highlighting today. First, we have asset accounts. Second, we have liability accounts. Third, we have capital accounts. Fourth, we have revenue accounts. Fifth, we have expense accounts. And finally, we have accounting equation. Remember, part of the accounting system is the accounting manual, correct? So what is meant then by accounting manual? When we say accounting manual, this is a system that will guide the accounting personnel in the proper treatment of every transaction so that there will be consistency in the application of all transactions. And the accounting manual contains the following information. First, we have charts of accounts. Second, financial reports to be generated. Third, book of accounts. Fourth, company policies and procedures. And finally, we have duties and responsibilities of accounting personnel. Now, let me discuss to you first chart of accounts. So what is meant by chart of accounts? When we say chart of accounts, this refers to a listing of all account titles that the business will use. Now, there are three types of chart of accounts. First, we have asset accounts. Second, we have liability accounts. And third, we have capital accounts. And capital accounts has four components. First, we have capital account. Second, withdrawal account. Next, revenue account. And finally, we have expense account. When we say asset account, take note that assets are generally what a business owns and is therefore defined as resources controlled by the entity as a result of past transaction and events and from which future economic benefits are expected to flow to the entity. This is according to Valix, Peralta, and Valix of 2009. On the other hand, if we say liability account, remember, liabilities are generally what a business owes and is therefore defined as present obligation of an entity arising from past transactions or events. The settlement of liabilities is normally expected to result as an outflow from the entity resources, embodying economic benefits. And this is still according to Valix, Peralta Valix 2009. And finally, when we say capital accounts, capital account is generally the residual interest, and it has four components. First, we have capital accounts. Next, withdrawal. Third, revenue account. And lastly, expense account. Now, what's the difference between them? When we say capital account, this refers to the investment of the owner. Again, refers to the investment of the company's owner. When we say withdrawal account, this is the temporary withdrawal account of the owner, normally used in single proprietorship and partnership businesses. On the other hand, revenue account, this is the account for the income of the company. And finally, we have expense account. And obviously, this is the account for the expenses of the company. Now that we already have an idea about what these accounts really are, the next thing I'm going to be showing you would be examples of each type of account in order for us to better understand them. Now, let me start to you with the asset account. Okay, under asset account, we have cash. And cash is a generic account. Some companies that engage in simple transactions usually use this account, which could either be on hand or in the bank. However, for a company to be more effective in directing its business, cash can be made more specific. And therefore, the following are the specific names of cash used both in academic field as well as in the industry. So the first specific name of cash is what we call cash on hand. Cash on hand denotes money or cash substitutes representing the collection of the company awaiting deposit to the company's depository bank the following banking day. Or if the company has collection on non-banking day, it has no choice but to wait for the next banking day. Another specific name of cash is cash in bank. It denotes to the money of the company that is in the bank awaiting payment. Now, if some companies maintain several bank accounts, an additional description representing the name of the bank appears. And because of this, it is highly suggested that when you use the account in the journal entry, you have to include the name of the bank. For example, ABC Corporation, Metro Bank, or ABC Corporation, BPI, or ABC Corporation, BDO. Okay, that's an example of how. And next we have cash in fund. It denotes money placed in a specific fund for a specific purpose. Now, one example for this is the petty cash fund. This is a fund intended to pay petty expenses. This is very helpful, especially that a company cannot issue a check for small expenses, correct? For example, you ask your employee to buy office supplies. Now, in buying office supplies, your employee spends cash for the jeepney fare, and it obviously means that we cannot issue a check as payment to the jeepney driver, if that makes sense, right? Now, therefore, we can get cash from the petty cash fund. And lastly, we have cash equivalent. Cash equivalent refers to short-term investment made by the company. It is generally accepted that only accounts under 3 months maturity will be considered on this account. Now, another type of asset account, or another example under asset account rather, that would be accounts receivable. And this refers to customers' accounts arising from selling activities. This account to a trade account receivable. This usually occurs if your customers didn't buy on cash. Instead, they bought your products on credit. And so for this matter, you have receivables from your customers. Another asset account is notes receivable. This refers to accounts receivable or collectible of the company. However, this is supported by a promissory note. Next, we have inventory. And inventory refers to the merchandise of the company intended for sale in the course of its business operations. This is also sometimes called as merchandise inventory. Another asset account that we have that would be prepayments. These are the advance payments made by the company. For example, the company paid rent in advance for 1 year. The advance payment is called prepaid rent expense. If we paid in advance for advertising expense, then we call it as prepaid advertising expense, okay? So next we have land, and this refers to the land owned by the company that is being used in business. And we need to take note as well that land is the only asset that will not depreciate. Again, this is the only asset that will not depreciate because its usage is infinite or endless. Another asset account, we have building, and this refers to the infrastructure owned by the company that is being used in the business. Next, we have furniture and fixtures. These refer to the movable furniture and fixtures that have no permanent connection to the structure of the building. Examples of furniture and fixtures, we have chairs, tables, air conditioners, cabinets, electric fans, desks, bookcases, partitions, and a lot more. These are just some of the many examples under furniture and fixtures accounts. Next, we have office equipment. Office equipment, these are long-term assets reported on the balance sheet under the heading of property, plant, and equipment. Included in this account would be computer, typewriter, fax machine, photocopier, telephone units, store equipment, etc. Okay, and lastly, we have delivery equipment. These are, or this is the account rather, that is used instead of transportation equipment sometimes. And next, that we have next type of chart account, that would be liability account. And under liability account, we have accounts payable and notes payable. Now, when we see accounts payable, it represents the liability account of the company arising from purchase of merchandise that is intended for use. On the other hand, notes payable represents a liability account supported by a promissory note issued by the company. And the last type of chart of account, we have capital accounts. And remember, this is divided into four components. We have capital, withdrawal, revenue, and expense. Now, if we say capital account, this refers to the investment of the owner. Example, X capital. Now, this refers to the capital account of the owner. And the letter X represents the name of the owner. In academic problem, whenever the name of the owner is given in, then you should replace X with the name of the owner as stated in the academic problem. Supposing the name of our owner is John Smith, so therefore, when you do the accounting or the preparation of journal entry, so you should write John Smith capital. Okay, you replace X with the name of the owner, John Smith. Again, John Smith capital. Next is withdrawal account. This is the temporary withdrawal account of the owner. Example, X withdrawal. So similar to capital account, whenever the name of the owner is given in an academic problem, we should use the name of the owner instead of the letter X. So supposing the owner made a withdrawal, so the name of the owner is John Smith. So therefore, we write John Smith withdrawal. So we replace X with the name of the owner. And another component of capital account is revenue account. And revenue account refers to the account for the income of the company. Now, examples of revenue account, we have service income, interest income, sales, sales discount, sales returns, and sales allowances. And lastly, we have expense account. When we say expense account, this is the account for the expenses of the company, and the examples for these will be discussed later on. Okay, let us discuss first the examples or the different account names under revenue account. So let me discuss first what a service income is. Now, when we say service income, this type of account is usually used by companies, especially those who render services, in order to earn an income. So in short, we can only use this account name, especially if the type of the business is a service industry. Examples of this type are beauty parlors or beauty salons, barber shops, repair shops. So if you own businesses like this, then the first term or the first account name that should be appearing on your income statement, that should be service income, okay? Because your business is into business type of industry. Okay, second, we have interest income. This type of revenue account is normally used whenever company's income is earned out of lending its money or depositing money with a banking institution. Now, normally, the examples under interest income type of revenue account are the banking institutions because they normally lend their money to the companies. And another type of account under revenue account that would be sales. This is a revenue account for merchandising type of business organization that is used in selling merchandise. And when we say sales discount, it represents cash discount given to customers for settling their accounts on time. So if you're the customer and you have payables and you settle your accounts on time, then normally you will be given by the seller with a sales discount, okay? Next, we have sales returns. It represents actual returns made by the customers due to wrong delivery, wrong shipment, or defective merchandise. Now, remember that even companies, they are not perfect. So sometimes they commit errors, they deliver the wrong products, or there is a wrong shipment, or may it be that they deliver a defective product. And once this is received by the customer, so being you as a customer and you receive a defective product, you return the product to the store where you bought it. So that is what we call sales return. And next we have sales allowances. It represents no actual returns, but to an allowance given instead for the defective merchandise delivered. And on the other hand, under expense accounts, we have 11. I have cited 11 account names under expense account. And these are the following. First, we have purchases. These are merchandise purchases which are intended for sale. And second, we have purchase discount. It is a sales discount, or it is a discount rather, given by merchandisers when you pay your liabilities on time. Next, we have purchase returns. These are actual returns of merchandise you return to your supplier due to wrong delivery, wrong shipment, or defective merchandise. Next, we have purchase allowance. These are the allowances given by the supplier representing reduction of price for purchased merchandise due to defects. Next, we have salaries and wages. And salaries and wages expense represents the labor payments to employees of the company. And next, we have employee benefits. These represent the labor payments to the employees other than the basic payments that are highly discretionary on the part of the employer. So examples of employee benefits, we have bonuses, we have uniforms, meal allowances, your 13th month pay, and also your vacation and sick leave benefits. Okay, so these are just some of the many examples under employee benefits. Next, we have office supplies expense. It represents various office supplies used by the office like coupon bonds, pencils, ballpoint pen, papers, paper clips, etc. Another expense that we have that would be utilities expense, and these are expenses arising from your light or electricity. You have your water bills and telephone bills. And rent expense, on the other hand, this refers to the rental expenses of the business. Sometimes companies don't own their own land, so they have to rent a land or they don't own their own machine, so they have to rent a machine. So these are our examples of rental expenses of the company. Next is advertising expense. These are the costs of promotion and advertising the products of the business for the purpose of improving its sales performance. And lastly, we have insurance expense. This represents fire and burglary insurance of various assets of. Now, after learning the basic terminology in accounting, preparation is the next step. And this time, the focus is on how financial reports are prepared in systematic manner, observing therein the various accounting principles so that users can rely on such information. Remember that accounting is a language of business, right? And therefore, more accounting terms will be introduced as we go deeper in the study of accounting. And one of those is the accounting cycle. So what is meant by accounting cycle then? If we say accounting cycle, this refers to the holistic process of recording and processing all financial transactions of a company from when the transaction occurs to its representation on the financial statements to closing the accounts. Remember, there are two phases of accounting. The first phase of accounting is called bookkeeping, and bookkeeping comprises of three parts. We have recording, classifying, and summarizing. And lastly, the last phase of accounting is interpretation. Now, this being said, one of the main duties of the bookkeeper is to keep track of the full accounting cycle from start to finish. The cycle repeats itself every fiscal year as long as the company remains in business. Also, the accounting cycle incorporates all the accounts, the journal entries, T accounts, debits and credits, and adjusting entries over a full cycle. And here, on our first key area that I'm going to be highlighting today, we will be discussing the accounting cycle. Now, the accounting cycle is comprised of 10 steps. First is evidence gathering to support a transaction, or other authors call it identifying transaction. Now, the first step, here in the first step of accounting cycle, identifying the transactions from the events is the first step in the accounting process. Events are analyzed to find the impact on the financial position, or to be more specific, the impacts on the accounting equation. Documents such as a receipt, an invoice, a depreciation schedule, and a bank statement, etc., provide evidence that an economic event has actually occurred. So that is the first step of the accounting process, evidence gathering to support a transaction or identifying transactions. So if there is a transaction that really transpired, there should be a proof of evidence, such as mentioned earlier, a receipt, or may it be an invoice, a depreciation schedule, because you will be using that one as a proof that there is really a transaction. And the second cycle, or the second step in the accounting cycle, is recording transactions in a journal. Now, after having identified and analyzed the transactions, the next step is to record these entries in the company's journal in chronological order. When I say chronological order, what I mean about it is that the transactions should be recorded according to the dates as to when the transaction occurred or transpired. In debiting one or more accounts and crediting one or more accounts, the debits and credits must always be balanced. After recording transaction in a journal, the third step of the accounting process, that would be posting from the journals to the general ledger. So after recording transactions in a journal, the journal entries are then posted to the general ledger, where a summary of all transactions to individual accounts can be seen. Okay, so the general ledger provides a breakdown of all accounting activities by account. This also allows a bookkeeper to monitor financial positions and statuses by account. And one of the most commonly referred accounts in the general ledger is the cash account, which details how much cash is available. And take note as well that, as we learned in the previous chapter, general ledger is called the original book because, or the first book of entry, because this is where transactions are being entered first. Okay, so the next step in the accounting process or cycle, that would be preparing the unadjusted trial balance. Now, to determine the equality of debits and credits as recorded in the general ledger, an unadjusted trial balance is then prepared. It is a way to investigate and find the fault or prove the correctness of the previous steps before proceeding to the next step. When we say unadjusted trial balance, it actually makes the next steps of the accounting process easy and provides the balances of all the accounts that may require an adjustment in the next step. And take note, the unadjusted balance sheet is for internal use only. Okay? After preparing the unadjusted trial balance, then the next step of the accounting cycle is recording adjusting entries. When we say adjusting entries, these ensure that the revenue recognition and matching principles are followed. Again, just a brief recap. When we say revenue recognition, it is an accounting principle that determines the specific conditions under which income becomes realized as revenue or income. And generally, income is recognized when a specific event occurs and the income pertaining to it is measurable. Moreover, income is recognized when the company delivers merchandise or services to its customers. On the other hand, if we say matching principle, this principle states that the reason the business earns an income is because it simply spends. And so for this matter, for accounting purpose, we will match the expense incurred to the revenue earned. Therefore, to find the revenues and expenses of an accounting period, adjustments are required. Adjusting entries are required to be is because a transaction may have influenced revenues or expenses beyond the current accounting period, and to journalize the events that not yet recorded. Okay, so that's the fifth step. Now, the next step in the accounting cycle is the preparation or preparing the adjusted trial balance. An adjusted trial balance contains all the account titles and balances of the general ledger, which is created after the adjusting entries for an accounting period have been posted to the accounts. Also, it is an internal document and is not a financial statement. Again, Your adjusted trial balance is just an internal document and is not considered as a financial statement. It just helps to create the income statement and balance sheet and provide enough information for preparing the cash flow statement. And the seventh step in the accounting cycle, that would be called preparing the financial statements. If we say financial statements, these are presented from the balances from the adjusted trial balance. Again, these are presented from the balances from the adjusted trial balance. The financial statements are then made at the very last of the accounting period. Now, usually, the financial statements that are prepared at the end of the accounting period are income statement, statement of financial condition, or also known as the balance sheet, statement of cash flows, and the statement of retained earnings. These financial statements are the output of the accounting process, which are then used by the interested parties, both the internal and external users. And the eighth step of the accounting cycle, that would be recording closing entries. Now, at the end of the accounting period, closing entries are made to transfer data in the temporary accounts to the permanent balance sheet or income statement accounts. Transferring the balances of the temporary accounts or nominal accounts such as revenue, expenses, and joint accounts to the owner's equity or retained earnings account is used because these types of accounts only affect one accounting period. And the ninth step of the accounting cycle, that would be preparing a closing trial balance. Again, okay? So to make sure that debits equals credits, the final trial balance is then prepared. Now, as the temporary ones have been closed, only the permanent account appear on the closing trial balance to make sure that debits equal credits. And the last step of our accounting cycle, that would be recording reversing entries or preparing of reversal entries. So post-closing entries are optional step of the accounting cycle. Again, this is just an optional step. A reversing journal entry is actually recorded on the first day of the new period for avoiding double counting the amount when the transaction occurred in the next period. All right, so this is what accounting cycle is all about. So just a brief recap about accounting cycle. First, we can tell that the general ledger serves as the eyes and ears of bookkeepers and accountants and shows all financial transactions within a business. And essentially, it's a huge compilation of all transactions recorded on a specific document or on accounting software, which is the predominant method nowadays. For example, if you want to see the changes in cash levels over the course of the business and all the relevant transactions, you would look at the general ledger, which shows all the debits and credits of cash. And lastly, to fully understand the accounting cycle, it's also important to have a solid understanding of the basic accounting principles. You have to know about the revenue recognition when a company can record sales revenue and the matching principle as well, matching expenses to revenues. Now, the next key area that I'm going to be discussing right now, that would be accounting equation. And our accounting equation, that would be assets equals liabilities plus owner's equity or capital. Now, just a brief recap. If we say assets, These refer to those resources controlled by the entity as a result of past transactions or events, and from which future economic benefits are expected to flow to the entity. On the other hand, if we see liabilities, these are the present obligation of the entity arising from past transactions or events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. And finally, we have owner's equity or capital. This is the residual interest in the assets of the entity after deducting all of its liabilities. And remember that there are four components of capital, and these are investments, also known as capital account. Second, we have withdrawal. Third, we have revenues. And finally, we have expenses. Now, if we say investments or capital, this is the resource that the owner has transferred to his business as a startup additional. And our investment will increase our capital. Now, this may be in the form of cash or tangible assets that can readily be used in the business. For example, we have the land, building, furniture, equipment, etc. Okay, next we have withdrawal. This is the temporary withdrawal of the owner, whether cash or any other assets of the company for personal use. And withdrawals or drawings will decrease our capital. Next, we have revenues. And if we see revenues, these are the increase in economic benefit during the accounting period in the form of inflow or increase in assets or decrease in liability, which results in increase in equity other than contribution from equity participants. And our revenues will increase our capital. And finally, the last component of capital is expense. And expense is the decrease in economic benefit during the accounting period in the form of outflow or decrease in assets or increase in liability, which results in decrease in equity other than distribution to equity participants. And our expense will decrease our capital. Now, if we take a look at the capital, there are two components which will increase capital, and these are our investments and our revenues. On the other hand, the two components that will decrease our capitals are withdrawals or drawings and expenses. Therefore, for the purpose of determining the normal balance of the accounts, the equation will be presented as follows. Now, it is very important that as a learner, you should know the normal balance of the account. But what is meant by the normal balance of the account? Now, if we say normal balance of the account, it is the increase side of the account. And therefore, if there is an increase in the company's assets, drawings, or expenses, then you have to debit the account. Conversely, if there is a decrease in company's assets, drawings, and expenses, you have to credit the account. Now, this is the same way with the other side of the equation. If there is an increase in liabilities, investments, and revenues, then we have to credit the account. Otherwise, we need to debit it. Okay. Now, as you can see on the tabulation, assets can be found on the left side of the account. So this is the left side of our T account, and therefore, this is debit. On the other hand, our liabilities and capital, these are the right side of the T account, and therefore, this is credit. Now, on matters of analyzing a transaction, whether the account will increase or decrease, then it is imperative to learn the basic rule on when to debit and when to credit. Now, the reason we need to learn when to debit and when to credit is because this is one of the basic issues in accounting. And as you can see on the presented tabulation, when a transaction causes our assets, expenses, and drawings to increase, then we have to debit our account. May it be an asset account, an expense account, or a drawing account. However, if the transaction causes assets, expenses, and drawings to decrease, then we have to credit our account. On the other hand, when a transaction causes liabilities, capital, and revenue to decrease, then we have to debit the account. However, if the transaction causes the increase of liabilities, capital, and revenue, then we have to credit such accounts. Therefore, in order to avoid committing error regarding debit and credit, then we need to be familiar with the rule and stick with it. Now, we will summarize the rules of debit and credit in the following matrices or models. Now, we have 6 models in order to be able to summarize the rules of debit and credit. And the first model that we have is increase in asset and increase in capital. Now, in this case, the components of capital which will increase, that would be our investment. Now, in order for us to better understand model number 1, let us have an example. But before giving the example, this is how our figure looks like for model number 1. So as you can see on the figure, this is how model number 1 looks like. As you can notice, we are using accounting equation, which is assets equals liabilities plus capital. Okay, so going back to model number 1, it states increase in asset, increase in capital, which is our investment. Now, in terms of assets, it will obviously increase. And in terms of liabilities, can you see any liabilities in model number 1? No. Therefore, it has no effect on liabilities. And finally, on the capital side, it will increase specifically the investment. Now, under model number 1, usually the examples under this type of transaction is the investment of the owner, whether initial or additional investment. Now, in order for us to better understand model number 1, let us have an example. Example, Paul, the owner, opened up a business enterprise with a trade name of VNR Services and invested 100,000 pesos in cash into the business. Now, in the previous chapter, we discussed about the accounting cycle, right? And we learned that accounting cycle is comprised of 10 steps. And the first step in the accounting cycle is data gathering or transaction analysis. And so for this matter, applying the steps of accounting cycle, the first thing that we need to do is to apply step number 1, and that is data gathering or transaction analysis. Now, in analyzing our transaction, there are actually 3 ways to do it. First, we need to determine the accounts involved in the given accounting problem. Second, we need to determine the effects of each account towards our assets, liabilities, and capital. And finally, we need to evaluate if we debit or credit the said accounts involved. Now, going back to our problem, Paul, the owner, opened up a business enterprise with a trade name of VNR Services and invested 100,000 pesos in cash into the business. Now, if we try to analyze the problem, it is very clear that there are two accounts involved. First is the cash worth 100,000 pesos. And second, as you can notice, there is a word invested in our problem, right? So, meaning to say, the 100,000 pesos was invested by Paul to his business, and therefore this is capital. And so you can recall there are two sample accounts under capital account. First, we have X capital, and second, we have X withdrawal. And remember, X refers to the name of the company owner, and therefore our second account involved is Paul capital. So this is the first step in analyzing the transaction. Now, the second step in analyzing the transaction is to determine the effect of each account towards our assets, liabilities, and capital. So in this case, our cash will increase our asset since basically the company received 100,000 pesos in cash. On the other hand, there will be no effect on the liabilities. And lastly, it will increase our capital since Paul, the owner, invested money into the business. Now, this ends our second step. Now, the last step in analyzing a transaction is how we treat our asset account and capital account. And so for this matter, we will ask ourselves, which account will be debited and which account will be credited? Now, in order to answer this question, it is imperative to go back to the basic rule as to when to debit and when to credit. Okay, going back. Okay, so this is our basic rule as to when to debit and when to credit. Now, based on the rule, if we increase our assets, expenses, and drawings, we need to debit the account. Otherwise, we credit it. On the other hand, if we increase our liabilities, capital, and revenue, we credit the account. Otherwise, we debit it. Now, since cash is an asset, okay, so we will encircle our asset, and therefore, this asset, since this asset rather will increase. On the other hand, since Paul Capital is a capital account, so as you can see on the tabulation, we encircled capital because Paul Capital is under capital. And since Paul Capital will increase our capital, so we encircled increase, and therefore we will credit the account. Okay, so this is the first step in accounting cycle. We gather data, data gathering or transaction analysis. So what we did, we just analyzed our transaction. Now, the second step in the accounting cycle is to do journalizing or journal entry preparation. So how do we journalize then our transaction? Now, before getting into that, this is our finalized tabulation. So what we did on our asset cash, we debit the cash. And what we did on our capital, Paul Capital, we credit Paul Capital. Now, in journalizing, so this is how our journal entry preparation looks like. So under debit, you have cash, 100,000 pesos. And under credit, you have Paul Capital, 100,000 pesos. And after that, there should be a brief description of the transaction. Okay, so our brief description in this case, that would be to record the investment of Paul. Okay, so moving on to model number 2. Now, our model number 2 is increase in assets, increase in capital. So in this case, the component of capital which will increase is our revenue. Now, in order for us to better understand model number 2, let us have an example. So, for example, V&R Services rendered services to customers amounting to 50,000 pesos. Now, apparently in this problem, VNR Services is the name of the company, and obviously it's a service industry as well, since it rendered services to its customers. Now, the first step in analyzing our transaction is to determine the specific accounts involved. Now, based on our problem, as you can notice, there are two types of accounts involved. First is cash receivable, and second, we have service income. Why cash receivable? Cash receivable, it's because the company rendered services to its customers amounting to 50,000 pesos. However, we have not received such amount as of yet. It is still a collectible of the company. So that is why it's considered cash receivable. On the other hand, we also have our second account, service income, because that will become an income of the business itself, which is VNR services. Okay, now the second step is to determine the effects on towards our assets, liabilities, and capital. So in this case, it increases our asset, no effect on our liability, and it increases our capital as well. Now, the last step is how we will treat these accounts. Now, going back to the basic rule, since cash is an asset, so we will encircle asset, and since our asset cash will be increased, and therefore we will debit cash. On the other hand, since service income is under capital, and so we will encircle capital, and since our capital will increase, and therefore we will credit the account. Okay, so this is step one of the accounting cycle, transaction analysis. So moving on to the second step in the accounting cycle, the journal entry preparation. But before going over into that, this is how our finalized tabulation looks like. Again, as I said earlier, our cash receivable should be debited. Our capital service income should be credited. Now, this is how our journal entry preparation looks like. Now, under debit, you have cash receivable, 50,000 pesos. And under credit, we have service income, 50,000 pesos. And therefore, our brief description, that would be to record the services rendered for cash. Okay, so this ends our discussion for model number 2. Now, moving on to model number 3. Now, model number 3 is increase in asset, increase in liability. Now, as you can see on the figure, there is an increase in the assets, increase in the liability, and no effect on the capital. And so, for every increase in asset, there will also be an increase in liability. Now, in order for us to better understand this model, let us have an example. For example, VNR Services borrowed money from Bank X amounting to 300,000 pesos to finance its operations. Now, the first step that we need to do in order to solve this transaction is to analyze our transaction itself. Now, we need to analyze the transaction in order for us to determine the specific accounts involved. And as you can notice, there are two accounts involved in our problem. First, we have cash, and second, we have loans payable. Now, loans payable because you borrowed money from Bank X, meaning you owed money from the bank. And since it's a loan that needs to be paid, so that is why our one account is loans payable. Another account that we have is cash, because when you loan that money, your company received 300,000 pesos in cash. And so that is why our second account is cash. Now, the second step in analyzing the transaction is to determine the effects of each account towards our assets, liabilities, and capital. And so in this case, our cash will increase our assets since basically the company received 300,000 pesos in cash as it loaned money from the bank. On the other hand, our loans payable account rather will increase our liability since it's a debt obligation that we need to pay. And lastly, there will be no effect on our capital account. And finally, the last step in analyzing the transaction is how we treat our asset account and liability account. Now, the question now is which account will be debited and which account will be credited. Now, in order for us to better understand or answer this question, rather, it is imperative to go back to the basic rule as to when to debit and when to credit. Now, based on the rule, if we increase our assets, expenses, and drawings, we need to debit the account. Otherwise, we credit it. On the other hand, if we increase our liabilities, capital, and revenue, we credit the account. Otherwise, we debit it. Now, since cash is an asset, so we will encircle asset. And since we increase our asset cash, so we will encircle increase. So that is why we need to debit the account. On the other hand, since loans payable is a liability, so we encircle liability. And since our liability will increase, and so for this matter, we will credit the account. So this is how our finalized tabulation looks like. So what we did on our asset cash, we debit it. And what we did on our loans payable liability, we credit it, okay? So this is how our journal entry preparation looks like. Under debit, you have cash, 300,000 pesos. And under credit, you have loans payable, 300,000 pesos. And the brief description should be to record the proceeds of loan from Bank X. Okay, so this ends our discussion on model number 3. Moving forward to model number 4. Model number 4 is decrease in assets, decrease in capital. Now, as you can see on the figure, there is a decrease in assets, no effect on liability, and a decrease in capital. And so for every decrease in asset, there will also be a decrease in capital. Again, that is not a decrease in liability. Instead, that's a decrease in capital. Now, in order for us to better understand this model, let us have an example. Example, VNR Services paid rental expenses for the month amounting to 4,500 pesos. Now, the first step that we need to do in order to solve this problem is to analyze the transaction. We need to analyze the transaction. Like I said earlier, it is in order for us to determine the specific accounts involved. Now, if we try to comprehend the problem, there are actually 2 accounts involved. First, we have cash, and second, we have rent expense or rental expense. Why cash? Cash because we let a certain amount of money out from our pocket. And also, rent expense because our rental is already due and that we need to make a payment for it, okay? Now, the second step in analyzing the transaction is to determine the effect of each account towards our assets, liabilities, and capital. So in this case, our cash will decrease our assets since, like I said earlier, we let 4,500 pesos cash out from our pocket. And therefore, there was an outflow of our asset. On the other hand, our rent expense will decrease our capital, and there will be no effect under liability. And finally, the last step in analyzing the transaction is how we treat our asset account and capital account. Now, the question now is, which account will be debited and which account will be credited? Now, in order for us to answer this question, it is imperative to go back again to our basic rule. Now, based on the rule, if we increase our assets, expenses, and drawings, what do? We need to debit the account. On the other hand, if we increase our liabilities, capital, and revenue, what do? We credit the account. Otherwise, we debit it. Okay. Since cash is an asset, so we insert called asset, and since our asset will decrease, therefore, we will credit the account. On the other hand, since our rent expense is a capital, so we will insert called capital, and since our capital will decrease, and so for this matter, we will debit the account. So this is how our finalized tabulation look like. So our cash will be credited and our rent expense will be debited. And so for this matter, this is how our journal entry preparation looks like. So under debit side, we have rent expense, 4,500 pesos. And under cash, we have under credit side, we have cash, 4,500 pesos. And the brief description, to record payment of the rental for the month. And finally, we have model number 5. And model number 5 is decrease in asset, decrease in liability. Now, as you can see on the sample figure, there is a decrease in assets, decrease in liability, and no effect on capital. So for every decrease in asset, there will also be a decrease in liability. Now, in order for us to better understand model number 5, let us have an example. For example, VNR Services paid its loan account with Bank X amounting to 300,000 pesos. Now, the first step that we need to do in order to solve this problem is to, again, we need to analyze our transaction. We need to analyze the transaction in order for us to determine the specific accounts involved. Now, based on the given example, there are actually 2 accounts involved. First, we have cash, and second, we have loans payable. Now, the second step in analyzing the transaction is to determine the effect of each account towards our assets, liabilities, and capital. So in this case, our cash will decrease our assets since, like I said earlier, we made a payment on our loan and therefore there is an outflow of our asset. And aside from that, our liabilities will also be decreasing. So it will decrease our liability since we already made a payment, a portion of our total loan, okay? So we made a payment since our loan was already due. So there will be a decrease in our liability. And again, there will be no effect on our capital. And so how do we treat our transactions then? So which account will be debited and which account will be credited? Now, in order for us to better answer this question, we need to go back to the basic rule. Now, as you can see on the basic rule, when to debit and when to credit tabulation, since cash is an asset and our asset decreased, so that means to say that we need to credit our asset cash. On the other hand, since loans payable is a liability, and since our liability decreased because we already made a payment of a portion of our total loan, and therefore, that means to say that we need to debit our liability loans payable. Okay, so this is how our finalized tabulation looks like. So again, what do we do with our cash? We need to credit it. And how do we treat our liability loans payable? We need to debit it. So this is how our journal entry preparation looks like then. So under debit, we have loans payable 300,000 pesos. And under credit, we have cash amounting to 300,000 pesos. And our brief description should be to record the payment of loan from Bank X. All right, I think that's a good place to stop. If you have questions, please let me know on the comment section below. And if you like this video, please don't forget to subscribe and hit the bell button for the latest updates. Thank you.